All right. Good afternoon, everybody. Welcome to the webinar for today. Hope everybody's doing fine. Glad to have you. And today is going to be we're going to talk a little bit about kind of an introduction to the next class that we have starting a week from Tuesday, May 11th. And this will be called Short Strangles Dan's Way. How I would do short strangles. Has anybody done short strangles? Anybody here done a short strangle is selling an out of the money call and an out of the money put. It's kind of a high probability trade that you would do in a vehicle for monthly or a weekly income, very high probability of winning. And so I call this short strangle Dan's Way just because, what's the reason that I would not, even though I know a lot of good people sell just out of the money calls and puts, right? And a lot of people do well with them. And there's nothing wrong for someone who has the capital, is doing it the right size and knows what they're doing. But who could tell me what are two reasons, if you had to guess, why I would never do short strangles as a principle, even though there's nothing wrong with people who do them? Yeah, number one, unlimited risk, but that's not the main reason, because people who do short strangles, they have unlimited risk, but they're confident in their ability to adjust it or to do something if it goes against them. The main thing is margin. And if you just sell, if you go to your brokerage firm and sell like an SPX or SPY and sell one out of the money put and one out of the money call, it'd be like, good grief, Charlie Brown, they're going to charge me a stinking fortune. So the net effect is your yield potential is very low. So by buying some hedges against it, some wings somewhere over the rainbow, yes, somewhere, that hedge, I'm doing, my short strangles, but I'm choosing to buy my hedges somewhere, right? Because I want to get a decent yield, right? Yes, to cut the risk, but that's not the main reason. The main reason is the yields aren't that good. When you can get much better yields by showing some kind of hedge. Does that make sense? Kind of a general viewpoint. So this class that we're going to be doing starting a week from Tuesday, we're going to focus on a lot more the craft, right? We're going to do these strategies live every class, follow every trade through like I do in every class. We're going to talk about where do you sell the put and the call? Where do you sell the put and call in a low volatility environment? Where do you sell the put and call in a high volatility environment or different market conditions? And how do you manage it if it goes against you? How much profit should you take? Can you do it in stocks? Which stocks are better than others to do it at? But we're going to get into a lot of the logistics. So I think what I'm going to do is on every class, I might put 2 to 3 trades on. I'm not sure, but I'm going to do this more in SPX and RUT, probably more SPX, but also for people who just want to do a smaller trade, we'll look at SPY, right? Because SPY is 10 times smaller. And then I'll always do a stock trade, right? There's a lot of, and I'll give you kind of a list of the stocks that I would consider doing this in. And, higher price stocks, a range bound, something like a Google versus an Apple, really, it's not high enough price, right? So that's kind of will be the template. I'll probably almost every class put on a Dan's version of a short strangle. I'll put on a live SPY trade, a live SPX trade, and a live stock trade. And occasionally I'll do a Russell or something. But that will give you the practice. Jamal says, if I'm new to options, is it better to start with an iron condor or calendar if you don't know how to manage options yet? Well, here would be my answer, Jamal. I don't think it matters those two. I think if you don't know how to manage options yet, right, could any trade be a problem? If you don't know how to manage options yet, would any trade be a problem? Yes or no? So here would be my advice to you, Jamal. If you took this class, which would be hedged short strangles, right? If you said, Dan, which would be better for me to do? I would say hedged short strangles. You know why? Because I'd be teaching it and I would be giving you how to manage it. Does that make sense? So if you take this class, I will go over thoroughly how to manage this trade, when to take it off for a profit or a loss, if we need to adjust it, if your schedule is busy and you don't want to do any adjustments, how to do a methodology where you don't adjust, what strike to put it on, when to not put it on, all those practical considerations. So with this class, and you'll also get plenty of practice. We're going to do, as I said, 2 to 3 live trades every single class, right? So if you want to get a heavy dose of practical trading, I think this will be good. And again, it'll be, I think for advanced people, you'll get a lot out of it because I'll be talking adjustments and a lot of intricate stuff. But a beginner, you'll get a lot out of it just because we're going to do repetition, right? We're going to do the transmission. We're going to do an oil change over and over and over and over till the cows come home. All right. So here's just an example, right? Just so you can get a flavor. And this isn't exactly what I would be doing or not doing as the market's going down a little bit. This is just an example of a short strangle. I'm going out to the June 18th expiration, and I'm looking at SPY. During class, we'll look at SPY, SPX, RUT, and some stocks like Google and others. So in this example, we're at 416.61. I'm just starting with SPY because that'll be much cheaper to do the trade. We're 416.61. Market's starting to go down a little bit, isn't it? I'll sell an out of the money call in SPY, the 380 put, or excuse me, I'm going to sell the 442 call. And I'm going to sell the 390 put. So this is a strangle. You're selling an out of the money call or out of the money put, 390. So that's 26 points out of the money. That's the equivalent of how many points out of the money in SPX. 26 points in the SPY would be equivalent to how many points out of the money in SPX? 260. So this is pretty far out of the money. And on the call side, I'm selling the 442s about 260 points out of the money, 26 points in SPY. So you've got a lot of, this is a high probability trade. The probabilities of us closing beyond the short call or below the short put are very low probability between now and June 18th. So we're going to go over in the class, the different durations we do and why. What do we think is the best duration? And some of that's based on volatility levels, and we'll give you clear guidelines. And then, so talk about durations, which strike to sell and which to buy. Some of that will be on market conditions. We'll give you clear guidelines. How wide to go? So I'm selling the strangle, the calls and the puts, and then I'm buying my hedges, 380 on the downside, and 452 on the upside. Can you guys hear me okay? Bob can't hear. Are you guys able to hear me okay? Okay. So if my hedges are 10 points further out of the money, how many points would that be in SPX? If my hedges are 100 points out of the money, yeah, 100 points. Yeah, that's a wide iron Condor, right? But these are hedged short strangles. So we'll also talk about in the class, how far should I go out on my longs? Like in SPY, should I go 10 points out of the money for my hedges? What if I go 20 points out of the money in the hedges, right? If I go 20 points out of the money in the hedges, will my credit of $1.67 be more or less? If I go wider on my hedges, what will that do to my credit? Higher credit, but lower yield. So on this example, if we just take, we're bringing in a credit of $1.67, right? I'm going to round this to $1.70 just for math purposes. I can do math better on $1.70 in my head than $1.60 or than $1.66. So if we just say we bring in $1.70 credit, say what's the maximum risk on this trade or margin? These are 10 wide spreads. So I have $1,000 of risk minus 170 my credit. So my risk is going to be $830, right? So what's the potential yield on this strategy? 170 divided by 830. What's 170 divided by 830? About 20%. So the potential yield in a 10 wide hedged short strangle strategy in SPY or a 100 wide hedged short strangle strategy in SPX is going to be about 20%. And so we're going to talk about that fine line. Should our hedges be 10 points away in SPY, which would be 100 points away in SPX? Should our hedges be 200 points away in SPX or 20 points away in SPY? I get more credit, but will I be happy with the potential yields? And then how much of those potential yields are we going to go after? So we're really going to get between the crevices and really get at where we would think ideal duration, ideal width of these short strangle hedges, how we would manage them, how we would adjust them, which vehicles do we like right now, when we wouldn't do them, weather conditions that we would do them, weather conditions we wouldn't. Cecil says, but wider spreads mean more risk. Yeah, as you get, there could be more risk. You get more credit. I think what we'll do is we'll examine them and compare everything, right? The yields and stuff, and we'll give our recommendations where we think how wide we should go with the hedges, right? I mean, I could go really, 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 really wide, right? But then my yields go down. So we want to find that happy medium, and we'll share that. So I think, and duration, this one is 49 days out, the June 18. When will we do shorter duration one? So I think that's what we're trying to come up with for you. We'll come up with a plan on doing these short strangle alternatives, how you can do them, and I think it will be a very helpful class. I think this is a good strategy to do long term. And, we talk a lot about the Greeks. How do we set up the position deltas at the beginning? When do we be a little bit short delta, a little bit long? So a lot of these practical things will give you. I'll have slides at every class so you can have this. And one thing I promise you, I will make this as, simple guidelines as possible, because I need those for myself as well as you. This won't be nuclear. This will be just very simple guidelines. Will I be holding these to expiration? No, not even close. The advantage, disadvantage of these over calendars for weekly income. Jack, I don't know if that's a conversation for this class. They're just different. Calendars benefit if volatility goes up. These type of strategies benefit if volatilities go down. This strategy has volatilities in its favor. I think they're complementary strategies because one benefits if volatility goes down, this short strangle hedge, and one benefits if volatility goes up. So they can, both of these would work together as good complementary strategies. So I'm excited about this class. I think you'll get a lot out of it. You get a lot of room in these trades. So a lot of the way we're going to structure it, if you're busy at work looking for something a little more conservative, you don't have to babysit a lot. It's got very high probabilities, very well-defined risk, well-defined rules for you when to get out. I think this will be a great strategy for you. So look forward to seeing you. If you have any questions, you can email me, dan@sheridanmentoring.com, or you can email us at Sheridan Mentoring. But we look forward to starting this class a week from this Tuesday. And again, as in any 3-week class we do, it's $297, same rate we've had for years and years. We haven't increased it. And we have a web page. Each class has their own class page where you can ask questions. If you watch it recorded, if you miss a couple of classes or you miss all of them, in other words, you can't see it live, they'll be recorded. You can ask questions, and then these will be archived on your web page with the PowerPoints for a long time after the class. So thanks everybody for coming. Appreciate it. And we'll see you a week from Tuesday, May 11th at the Short Strangles Dan's Way class. John says, it looks like an iron condor to me. It's a form of an iron condor. I mean, really, there's many strategies that are in that category, right? When you think about an iron butterfly or an iron condor or a short strangle, what's the foundation? Selling a call in the put. An iron butterfly is selling a call in the put at the same strike. Iron condor is selling a call in the put out of the money. A short strangle is selling an out of the money call and put. Even a double diagonal of a foundation selling an out of the money call and put. So it is an iron condor, but it's much different than people typically trade iron condors. People don't typically trade iron condors in SPY 10 wide or 20 wide, and they don't trade iron condors 100, 200 wide, right? So it's a bit of a different animal. I think there's less, one of the advantages over this of the iron condor, less maintenance. You're going to have more room, less adjusting, less messing with it, right? So I think this is for people looking for a more conservative trade that they don't have to watch as much. I think this is better than an iron condor. Do we have a specific formula for setting up the trade? Yes, we do. Yeah, we've got specific. We have a specific formula, which delta to sell, which which one to buy, when to adjust, when not to adjust. Every nick and cranny, right, we will go over. And Sam, any nick and cranny that we don't cover, which I doubt we won't, you can ask. That's the great thing here. Through the website, through the class, any question you can dream up with, we'll try to answer to the best of our ability. So anyways, well, thanks a lot, everybody. We will see you a week from Tuesday. Have a wonderful day and a nice weekend. Thank you.